Hey everyone, welcome to the Be the Bank broadcast. It is October 12th, 2022, and I'm back this month. I was off last month with going to my daughter's cross country meet. So I had Richard and Larry Mariska take over for me, and I don't know how they did. So you're going to have to, throw a comment out there and let me know how they did. Richard's going to be on the call today again, and we are going to be discussing kind of what's going on in the mortgage industry today with the rising interest rates and home affordability and what markets are hot, what markets are not hot. And we got a case study for you. So stay tuned. Welcome back to another broadcast brought to you by Bright Path Notes. Richard Thornton is on with us today. Richard, how are you today?
Good. And you, sir?
I'm doing pretty well. I'm back and better than ever, baby. I took off a month. I think that's the first time. I'm sorry. That's probably the second time since I've been doing this for since 2017, 2018 that I've actually missed one of these broadcasts. I wasn't on as your host.
Wow. I keep meaning to ask you this, and I never have. On your little opening presentation there, you've got a guy who's kind of balding. He's got his head's behind his back. All we see him is the back. Did you have to pose specially for that picture? Get all dressed up?
They just caught me. I was doing a lot of deals at that time, and I was just chillaxing. It's
okay. All right.
That actor just happens to look like me, so I'm the famous one, and that actor's just my stunt double.
I see. Yeah. Okay. Just want to make sure.
Yeah. You notice during the video or the sound in the video for the intro and stuff, it speeds up really fast and then it slows back down to the normal tempo. I don't know what that is, but I just saw that or heard that today, and I was thinking to myself, that sounds kind of funny, and I had to think about it. It's like, hey, maybe it speeds up and it slows down. So, anyways, Richard. So how have you been? You've been good?
I've been good, thank you. We are in fall here in California. It's we're getting a little bit of nip in the mornings, and it's kind of nice. I imagine you've got a lot of that up there, but yeah.
It's been intermittent. So for those of you listening and hearing us right now, Richard is in California by the Bay Area. I am towards the Indianapolis, Indiana area. So our weather has been up to 75 sunny, a little bit of wind, and it's hit as low as about 32 in the morning a couple of days. But for the most part, today and tomorrow will probably be our last warm days. It'll probably get up to 70. And we're going to probably trend towards the 50 to 55, 60 degree high weather for a while now. Until we get closer to January. Then we'll start getting down to the teens and 20s.
Try time to winterize those houses. If you have anybody out there, if anybody's got a foreclosure or anything that's vacant, get your folks out there to winterize it and button it up so that you don't have a whole bunch of frozen pipes.
That's true. Yeah. If you invest in the Midwest, you are aware that winter is coming, as the Game of Thrones saying is. Winter is coming.
I must admit, when I first started investing in notes, and one of my first deals that I had that went sideways on me, my servicer called me and said, "Well, do you want us to winterize the house?" And I said, "What? What does that mean?" I had no idea what that meant.
Yeah.
I've never heard of winterizing a house. You just don't do it out here.
Yeah, the process isn't too invasive. It's, you're just pumping antifreeze into some of the pipes so that they can not burst and freeze. And you're just basically preparing the winterization of the house for that reason. And then you want to make sure your property is secured. We can have a whole other conversation on that. We probably should have a conversation about those things. And we could probably bring on one of our vendors or one of our experts that we use that could speak, more fluently than we can.
Well, that's a good idea. Actually, sort of what do you do in the foreclosure process and how do you go about it? Not just simply the paperwork, but there's, I've got one right now that the borrower very nicely, well, he didn't make payments for a couple of months. So I called him. I said, hey,
Yep.
what's going on? And he very nicely said, look, I was just about to call you. I'm sorry. My brother died. We were living in the house together, can no longer make the payments, and the keys are under the mat. Very nice about it. But
Yeah.
so now I'm going through, and as it turns out, I got noticed 2 weeks ago on that, and it should go on the market this Friday.
That's amazing. We've actually had a couple borrowers do that over the past year. Is they just basically said we're just willing to walk away from it. I'm like, really? Because you could sell it and you could probably make some money, put some money in your pocket, and they're just like, nope, we just want to walk away from it. I'm like, okay.
Well, yeah. So in this case, I mean, if I, according to the BPO, I could probably make well over $100,000 on this if I wanted to go in and fix it up. And I think I'm just going to sell it as is.
Yeah.
But even at that, the borrower's walking away from a lot of money in those deals. He just had had the mind to sell it himself.
Had their wits about them, right?
Yeah.
Those of you that don't know what BPO is, Richard said BPO, it's broker price opinion. It's basically you get a valuation from a realtor's point of view, from driving exterior from the property and driving by it, just taking photographs of it, and you're just getting valuation from them based on comps in the area. That's what the BPO means.
Right.
So, Richard, this broadcast is obviously sponsored by Bright Path Notes today. So those of you that are watching on YouTube, on Facebook, on Twitter, LinkedIn, where else are we on? On our Facebook page for Bright Path Notes. This is going to be recorded, so you can watch it later if you have to exit and come back to it. But we encourage you also to create comments through whatever medium you are watching right now, and we will see them live here. And sometimes we bring them up during the conversation today, and sometimes we wait till the very end, and we'll have kind of like a fireside conversation, if you will, at the end for more Q&A and more banter on specific, not to our presentation today, but just specific about the real estate and the note business as well. Or we can talk about Richard's fashion statements.
Right. You can get a hold of us. I brought this banner up right now. So that's how you can get a hold of us. And also I'll bring it up later when we're actually talking more about deals, but just in case you want to get a hold of us.
That's a good segue into getting our PowerPoint up. So bear with us just a few seconds. That was not it. That was a false alarm. That was the wrong button. The sound engineer, the engineer in the background screwed up. It wasn't me, I promise.
Man.
I'll try it again. It's just a small mouse click away, Richard. I just hit the wrong button. It's just a very small mouse click away.
It's you're just getting back in the saddle. It's okay.
I know. I take a month off and just everything goes to crap.
I brought up the banner a little bit early. You hit the wrong button, so
it's okay. We're gonna get back in our groove, everybody. Don't worry. Okay. All right, this broadcast wouldn't be possible without some sponsorship. So my company, Bright Path Notes, Justin Bogard, Justin at brightpathnotes.com. We've got the deal flow to make your cash flow. So we got all the note deals, and we're gonna bring one up for you today as well for you guys to look at, poke, prod, and purchase if you would like. Cyria is also part of our sponsorship here. They're a local club to the Indianapolis area, and you can email the executive director at cyria.club for more information if you want to be a part of the group. They have typically between 700 to 800 members, and also vendors as well. They can be local boots on the ground. We have a lot of wholesalers here in Indianapolis, a lot of fix and flippers, a lot of landlords. So if you do invest in the Midwest here or invest specifically in Indiana, it's a great group to be a part of, even if you're from a distance. So we highly encourage you for that as well. Let's see my next slide here. Oh, the note investing training. It's been going very well, Richard. We've gotten a lot of positive feedback from it for folks that have been involved in it. That's called Constant Cash Flow. So myself, Richard, Larry, and Rishka have all kind of, since I think it was over COVID, I think is when we started recording a lot of those, the training. So it's a couple of years ago, I think. I'm sorry, Richard, what?
Didn't have anything else to do.
Didn't have anything else to do. That's right. We couldn't go outside. We could only talk to each other virtually, which is what we do now anyways, right? Anyways, you can find out more information to email at info@brightpathnotes.com for a constant cash flow training course. It's just foundational knowledge for the note investing environment. It gets you pretty much figuring out what direction you want to go in the note business. It's about 25 plus videos. All the videos are in between about 5 to 9 minutes long. We have a couple of case studies in there, and we also build more case studies as well when we load them into the constant cash flow course. And then once you're in for life. How's that sound?
Sounds good to me.
All right. Our New View Trust company is out of Florida. They are a self-directed IRA sponsor, and so they can do anything with your retirement account, and you want to use it to invest in notes or real estate or lend on or buy Arabian horses. I don't know. Whatever you can't do with your traditional retirement account, they can do it, and they can also do the same thing in your traditional retirement account. They can do college, Coverdale, educational savings account, health savings account. All these things can be investable in real estate. How beautiful is that? You want to mention this broadcast, and they're going to waive the setup fee. Email newaccounts@newviewira.com and get started. Richard, this is a special slide for our Cyrea members. So this broadcast for tonight is a part of the Be the Bank meetup here locally in the Cyrea Club. It's a subgroup for it. So we just kind of combined everybody into one kind of setting here. So they have a Facebook, they have an Instagram page, they have a LinkedIn page, so they encourage you to follow them. They have a good YouTube channel with a lot of free videos out there if you guys look for more education. And if you're a part of that membership, you need to take your smartphone here. Oh, I have mine in front of me. Look, take your smartphone, get your camera out, wave it over that QR code right there. It'll pop up a URL, put your thumb on it, finger, whatever, tap onto it, and you can plug in your information to get your PHP credits for the Cyrea members only. If you're not a Cyrea member, you can disregard everything I just said about that.
What did we ever do without smartphones? How did we live?
We had dumb phones, and they flipped, and that's it.
Yeah.
They received calls. You know, I was talking to my daughters about phones the other day, and I remember when all the Nextel phones were really hot, the two-way radio ones. You hold them on the side, you can just start talking to them. I remember this kid that I was listening to in a conversation. I was a part of the conversation. He had the button held in. I swear he taped his thumb to the button and just was talking for like probably 15 minutes. And we were just like, I either had to listen to him or just hang up the call. But anyways, I digress.
I'm dating myself here.
Uh-oh.
But my first mobile phone was attached to a box that was the size of a shoebox and weighed 12 pounds. And it had a strap that went over my shoulder, and the handset set down on top of the shoebox. And I would walk around large projects. And if I needed to talk to somebody at the office, that's how I did it.
All right.
I wish I still had that mobile phone. It was analog.
Yeah, I remember the shoebox.
It weighed about 13 pounds.
I remember the phone. You had to have two hands on them just to hold the phone up.
Yeah.
All right, we got a podcast called Be the Bank Podcast. Surprise, right? Everything we got themed is Be the Bank. The podcast is an audio, pretty much only service that we have. It comes out every 2 weeks, every other week. And so we also record the video of that as well. Richard's on there quite a bit. And it's more about a 20 to 25-minute conversation. It's more debate, discussion type of topics and stuff. So you can, on all the podcast directories, you can download it, subscribe to Be the Bank. We highly encourage that. And Richard, our friend Michael, had a question. Right. And his question was, is New View Trust similar to Quest Trust? And the answer is yes. They're the exact same thing as far as they're custodian, and they can take your retirement account, do what you want. Equity Trust is another big name as well. New View is one of our sponsors, so that's why we promote them. So that answer your question, Michael, yes, they are similar.
We might just tell people, this is a sort of a good segue. You can go on the internet and just put in self-directed IRA companies, and you can pull up a list there of, I think it's almost 100 companies.
Really? 100 companies?
Something like that. I did it recently. It's quite a few. I don't remember how many. But the point is that I want to make here is that if you want to invest in notes before you move any of your 401k monies over or anything like that to any of them, quiz them a bit on how experienced they are with notes, because most of them don't know. It takes a Quest, a Camma Plan, an Entrust, a New View that has note experience to be able to administer them correctly. So
that's a good point, Richard. Yeah, thanks for bringing that up. And you're exactly right, because you have to go through a special process to be one of these specialized custodians to hold people's monies and be able to have them make correct investments and not lose your money, because that is important. They're a great buffer between you and your retirement account so that you can't touch it and do anything wrong with it.
Right.
All right, Richard. So I mentioned in the opening package there, we're going to talk about kind of what's going on in the industry. As far as the mortgage, we get all of our data from, well, a lot of our data that we get that we love to get is from Black Knight Financial Data. They have their own website. I believe it's blackknightfinancial.com. Don't quote me on that, but if you look up Black Knight Financial Data, you're probably going to find like a black knight, and I think they have some sort of shield or something that they're holding. You think of like a knight in shining armor. That's kind of the logo that they have. You know you're in the right place. So they have this mortgage monitor report that they come out with. And we used to do this almost every time that we run this broadcast. We used to bring this information up, especially during COVID, so we could see kind of what's going on. And we got to paint a picture as to, are we in a bad place? Or are we in a good place? And so your favorite word, BIPS, is come up here on their delinquency rate. Mm-hmm. And so there's 10 BIPS down on a delinquency rate. So Richard, we're at 2.79% as a delinquency rate for a country. And that is pretty low. So at worst during at worst during the real estate debacle in 2000, I want to say 11 or 12, it got up to about 11.5% as a delinquency rate. That's a lot.
That's right. So you need to, before you go too much farther, you need to remind people what BIPS stands for, or what a BIP is.
Basis points, right?
Right. And how many basis points are in 1%?
100.
You win. Ding, ding, ding.
I get a gold star.
You do. So
after COVID came, July of 2020, it spiked up to 7.75%, 7.75% as a national delinquency rate. And people panicked and they got really nervous, and the Chicken Little, the sky is falling. We had a podcast episode about that not too long ago, Richard, you and I. And so a lot of people thought that the S was going to hit the fan, right? We're going to have all these foreclosures, all this job loss, all this turmoil is going to go on. And it didn't really happen like that. So it got better and better and better and better as we went on through COVID. As far as all these forbearances, about 8.3 million forbearances. I'm going to pause that conversation. I'm going to finish what's on those overview stats here real quick, Richard, before I finish that thought, because I just realized that we need to talk about foreclosure starts. So it shows that it's up 14.7% at a red number and pointing upward, which means that the foreclosure starts from the previous month, it has gone up 14.7%. Not meaning these are month over month transitions. So it is nowhere close to what we were at the real estate debacle. I mean, we were having, Richard, 200 and some thousand foreclosures going on in a month across the country, and now we're up to 20,000. So we started in January of this year about 32,000, which is a lot. But overall, compared to what we were at our worst, we're nowhere near that. We're just a fraction of that. So don't panic. This is not a bad number. It's actually a good number. It's not nowhere near panic stage. Just letting you know.
So as we get further into this, I think from what I'm hearing from a lot of the different pundits is that they're thinking that rather than a tsunami, we're going to have a slow rise. So this increase in foreclosures and non-performing notes, it's going to be a result of that, could go on for 4 or 5 years.
Yeah.
But it's going to be slow to wind up and to finally get there. So what that says is now's the time to dip your toe in it, get in there and do a non-performing note or something. Buy a couple, find out what's good and what's bad, make your mistakes, and get your money lined up for when there's a lot more product out there. And there is more product lining up in the queue.
Yeah. It's not going to happen tomorrow, but it's going to happen at some point. So we think it's going to happen probably in the first or second quarter of next year. We'll probably start seeing a lot more inventory. There's inventory out there right now, but it's not like there's going to be a lot more. Okay.
Right.
But like Richard said, I agree with you. There's not going to be a tsunami. There's going to be some surges that come through, and it's going to be manageable. It's going to be a slow drip. I think that's how we described it over the past year or two. It's going to be a slow drip of non-performing. Whenever it starts coming down is when it starts coming down, and you'll be prepared for it. So, Richard, we're going to jump back to what I was talking about forbearances. So, it's 8.3 million forbearances because of a result of COVID. If you look at this chart, all this green says basically the people that got the forbearance, they just came out of it performing, meaning they start paying again. The 33%, the gray bigger sliver at the bottom, is people that refied out or they paid off their loan because they sold their house. So they refi because the rates were so low, or they sold off their house. So that's already 84% right there. And you can see the negative part of it is the red pie, and then the darker gray pie right below the red pie, and that's about 6%, and that's stuff in active foreclosure. So of the 8.3 million forbearances, only roughly about 500,000 are actually in active foreclosure. That's an interesting stat.
That's I'm comparing it to another Black Knight chart that I looked at this morning.
Yeah.
So they're talking about forbearances here, but they're saying that there are slightly over 1 million active foreclosures right now. So it's interesting just to talk about the two and to think about, well, how many of these 8.3 million forbearances are actually going to slide over into the active foreclosures? We don't know that yet.
Well, I think that's what they're saying, Richard. So maybe I'm reading it wrong, but how I was reading it is that all the green stuff is removed and expired. So that's 51% of 8.3 million is already out the door, it's not in forbearance anymore. 33% on top of that, another 2.7 million is already removed from this data set. So this data set is comprised of the entire COVID, since COVID happened.
Right.
People that got forbearances. So there's only about 500,000 left that are actually in active foreclosure. And some of the stuff you see on the left side there, on my left of the screen here, it shows it's still an active forbearance. So they're not reached any sort of penalty or so that's why they don't include it in the active foreclosure set. But just the forbearance data alone is active foreclosure, about 500,000. Yes, there are other foreclosures outside of this data set because those are kind of legacy loans that have come through. So that's probably where their Black Knight's getting that information and saying there's 1 million in there going through foreclosure. But we're just talking about, just as it relates, just for the audience here, just as it relates to the forbearances, just because of COVID.
Cool.
Yeah. So it can get confusing, right?
Mm-hmm.
So a home affordability is completely different today than it was many years ago, and it's only gotten worse. So Richard, this chart is pretty eye-opening, and I think we've seen this for a while, but putting data in front of you and seeing it on a chart makes it look kind of scary, but I think there's opportunity here. And so as you can see, the chart has years and months at the bottoms of it. It's basically picking out September of every couple of years and just showing you where the payment to income ratio is the blue line, and the green line is just the Freddie 30-year fixed mortgage rate, just to show you how, when the interest rate rises and lowers, how it affects the payment to income ratio. There's other factors that change it too, but you see what happened in 2006 in September.
Right.
There is obviously a delta between there. That's the largest delta that you see thus far until you get to 2006, right? So that delta spread shows a 33.8% of payment to income was required to make the median price household income to make the median priced home. That's confusing to say, but basically what they're saying is they've taken the entire scope of the country, and they're saying, we have figured out what the median household income is, and that's a number. Okay, I don't know what the number is, but let's just call it a number. Let's call it 50,000. Okay, and we say we've taken the average price home and the median price home. Let's say that is, I don't know, Richard, 150,000. I'm probably not close, but I'm just throwing out numbers here. So whatever that payment is to pay for that $150,000 home, that's what they're saying. The person that has $50,000 income, that's the percentage of their income it takes to pay for that priced home. So they're trying to compare the median to the median here, and that's the only fair data set to do it. Mm-hmm. So now that they do that, it's fair over every year. They can show the delta between the payment to income ratio versus the interest rate, and you can see when the interest rate dips, it helps, and when it rises, it doesn't help. And so now you can see a big disparity from to last month, if you will, because right now we're live in October. So it's 36.6% of the the median household income. That's what it takes. That is for the monthly payment to make on the median priced home in the United States today at a 6.29% interest rate back a month ago. I don't know what the interest rate is today. If anybody has looked it up, please chime in on the comment box. It'd be great just to have a data point for today. But it's probably a little bit above 6.29.
Yeah, I think one of my mortgage bankers texted me this morning and said he was at on a 30-year fixed, he was at 6.375. So that's not that different.
Okay. Does this surprise you, or does this think this is on point to where we were?
No,
headed?
I think this is very much on point, and I think, unfortunately, I think it's going to get worse.
Yeah.
From everything I'm reading, and I'm certainly no expert. I just know what I read in the financial news.
You just slept at a Holiday Inn Express last night.
That's right. The Fed might have to raise even more. So
they probably will. How many more raises are left in the year? Do you know?
I don't.
I want to say it's a couple.
Yeah.
Because I know at the beginning of the year, I think they said they were going to do, I don't know what the number 13 sticks on my head, but that seems like it's too many. I think 9. Sound about right? 9 raises.
I mean, essentially, they could do one whenever they want, right? They could meet.
No, they can't. They got to ask you, Richard. Remember, you have the phone next to you, and they have to ask you.
That's right. I forgot.
So this is interesting. So this brings up home affordability challenges. So does that mean there's more rental opportunities, or does that mean there's more seller finance opportunities, or kind of a mixed bag of both? I'm asking you the question.
Yeah, I mean, it means that it's going to be much more difficult to buy a house, depending on whatever market you're in, and the area. I'm sorry, the price bracket that you're trying to buy in. You've lost anywhere from 25 to 40% of your buying power.
Yeah.
So if you were in Bay Area here, if you're buying a $2 million house, which is not that uncommon, you can now only buy $1.5 million house. That's a huge jump.
Yeah.
It's not that drastic in other parts of the country because prices aren't that high, but it's also making it more difficult for, even though they say multifamily is a good hedge against inflation because you can raise rents, it's getting it tougher for renters to pay the rent.
Yeah. Another analogy, just to piggyback off of what you said with the California pricing, and here in the Midwest, I think it's more close to home what I'm going to say. And the close to average mortgage payment is about $1,950 per month, just principal and interest. So 6 months ago, interest rate is about 3%. $1,950 payment will probably get you a $300,000 house.
Right.
6% interest rate, fast forward to a month ago, that $1,950 payment will now get you a $200,000 house. So you can't make any more of a payment or any less than a payment because that interest rate went up. Now you've lost, like you said, Richard, you've lost the ability to get a larger house. You have to downsize.
Yeah. Plus your ratios all start to get off. I mean, if you're in the terrible situation where you've got a little bit of money that you have to now have on credit cards, and you're carrying a little bit on your Macy's card or whatever, in a Chase card, all of a sudden your credit rating starts to drop, and that makes it harder to get a mortgage.
Yeah.
It's a terrible cycle.
Yeah. Let's talk about markets. So this was pretty interesting, Richard. We got most affordable markets and least affordable markets. I don't think I was surprised to see. I think I was surprised to see a couple of these on the affordable list side, but the non-affordable list or the least affordable list, I wasn't surprised about. So some of those are just down the street from you.
Why are so many of those in California? Those least affordables, huh?
I wonder why.
I wonder why.
The most inflatable market became the least affordable market, right?
Right.
It's a balloon up there. This doesn't surprise me. Miami, Florida, Newark, Riverside, California, San Francisco, San Jose, San Diego, Los Angeles. That doesn't really surprise me too much. Affordable markets, Chicago kind of surprised me being on there.
Yeah, yeah, I think so. St. Louis doesn't surprise me at all.
Yeah.
Nor does Detroit.
So the two columns that are here, payment to income ratio, and then you got payment to income 95 to 2003 average, and it's showing you the delta between them.
Right,
So obviously they all should be positive numbers because of inflation, right? So they'll be less affordable than they were in the, what is that, Richard? 20 years ago,
right,
20 to 25 years
right.
ago. So look at the delta in Los Angeles. It
Amazing.
says 36.6% difference from the 95 to 2003 average, which was 35% of payment to income ratio,
Mhm.
to 72.1%.
Right.
That was pretty eye-opening, the
That's off.
changes that are happening.
Right. That's off the charts. And so to that point, I got a call from a fellow last night. He wants a private money mortgage. And we chatted back and forth, and he and his wife are both in tech. They're
Mhm.
making, by anybody's standards, a lot of money. And he wants to buy a 3-bedroom house, which quite frankly is just sort of a ranch house in the San Jose area, and it's going to cost him $2.5 million. It's nothing special, but since rates have gone up, he no longer qualifies for the house he wants to buy. So he's asking me if I can arrange a second mortgage for him
Okay.
that won't be underwritten. It'll be private, so it won't be underwritten according to federal guidelines. And he's willing to pay 12%, which will amount to probably a two-year bridge. But it's going to be like a $300,000 loan that's a second on his house. And he's going to pay it down on an accelerated basis. But 6 months ago, he would not have had to have done that. But since
Yeah,
rates have gone up so much, he now is making calls to people like me.
that's amazing. Our friend Michael has a question. Are home sales slowing down? That's question 2. Thought I read an article that 25% of homes are purchased with cash. Any thoughts? That's a good question. So are home sales slowing down? And I think the answer is yes, they are slowing down. I think we're in a cooling market. We are not in a recessing market. We are not in a balanced market yet, but we are trending that direction, in my opinion. Richard, your thoughts?
I would exactly the same. Leveling off is the term that most of the realtors seem to use.
Yeah. So what about 25% of homes are purchased with cash? You know anything about that?
I don't know about that. Here in the Bay Area, it is surprising the number of houses that are so expensive that are purchased with cash. Now, there's a caveat on that, though. And the
Okay.
caveat is that the last house that I sold was bought by a younger couple. They were in their early 30s. It was $1.5 million house, and they bought it all cash. What I found out, though, was that they put down 25% cash, and mom and dad put down 75% of cash.
Cash comes in different ways from different people.
Yeah. So they had help.
Okay. Well, that makes sense. So I didn't know that, Michael. Thanks for bringing that stat up. I trust that your stat is accurate, the article that you read. So that's pretty interesting. So in the Midwest, I don't know for sure if I can say that's in the Midwest or not. It may be the case. So I can't really answer that, but definitely home sales are cooling down. So thanks for your question, guys. If you have any questions at all, don't hesitate to throw them in the comments box. We'll pop them up if we need to during this, or we can wait till the end and pop them up later. So, Richard, we're going to get into a case study and also present an asset really for sale and just show you guys kind of what we did, walk through it, get intimate with this deal per se. And so we're just going to walk through it real quick. All right, Richard?
I love it.
So this is called Sell. Big segue into Sell. So we've got a performing loan in Bluffton, South Carolina. And so this came from one of our strategies that Richard and I worked together on. And we have connected with a motivated seller. And Richard receives messages from them. He's talking with them back and forth and then getting them to the point to where they're interested in selling the note. And so I'll kind of let Richard start that conversation and explain to us kind of how the conversation went and how kind of long it took to get to the point to where they wanted to sell it and the reasons why. And I'll kind of jump into the numbers and the financing of it.
Right. So as you know, Justin, he and I have gotten a huge education in terms of marketing
Oh, yeah.
direct to the public in terms of anywhere from the lady who's had 5 husbands and wants to sell because she
That one never gets old.
Yeah, she has a vendetta against her sister, to somebody who just, very nicely wants to sell immediately because they just do, and there's no color on it at all. In this case, though, this lady, this is a condo, is what you're looking here. It was one of these units.
Yep.
And she was just sitting on the fence. She said, well, gosh, I really like the monthly income, but I really could use a little bit of money to pay off some bills and do some other things. So I just got a wish-washy answer from her. And I said, well, my follow-up was, well, can I call you back in 2 weeks, a month? Yes, call me back. Got no response for probably a month. And then texted her, and she said, well, I haven't made up my mind yet. I got nothing. 2 months goes by, 3 months goes by, 4 months goes by. I keep putting her on my tickler and just sort of tickling her and just seeing taking what her temperature is.
Let's choose different choices of words. Okay.
Yeah. Okay. Yeah. Okay. Right. Okay. I'll use a different word. Well, it's okay because I'm in California and she's all the way out in South Carolina. That's a long tickle. Anyway.
All right.
I keep calling. And she's nice enough, but she's really just very non-committal. And sure enough, about 30 days ago, she says, well, all right, I've decided to do it. And, voila, it's a good example of where you just have to sort of be tenacious, nice. You can't be a pest. You just have to sort of get the feel for somebody and what their tempo is and let it go at their tempo. And what has she been like to close with?
She was very helpful. She was very willing to work with us. Actually, it went by pretty quickly from what I remember. So this closed, Richard, I think, I want to say a month and a half ago. We've had so many deals. We're fortunate enough that we've had so many deals close that some of these are starting to run together. So I had to look up some information on it. But yeah, I believe it was about a month and a half ago. So like Richard said, this is a condo. I'm not really sure which one it is. It's the upper level. I guess the top level one, either the left or the right side. I'm not really sure which one. But basically, this is a pretty good looking condo in South Carolina. It's actually really close to Hilton Head. So it's just west of Hilton Head. So it's close to the beach. Maybe a half hour. To me, that's still close. I mean, I live in Indiana, so if I'm a half hour from the beach, I feel like I'm pretty close.
That's a good thing.
Yeah. All right. So we value this thing at $150K. I can't see any reason why it's anything lower than that. I've actually found a lot of sources that says it's higher value than that. Each of these condos or these units, as they call them, about $150K. So it's pretty nice. Mm-hmm. So we get into this deal, start underwriting it, Richard, find out that the sales price for this condo for the borrower back in 2017. So this is November of 2017 when it was originated, just for reference purposes. I didn't actually put that up there because I forgot to. Mm-hmm. Down payment was at $5,500, Richard. So that's a little over 10%. And we got $49,500 loan amount.
So before you go any farther, note that in less than 6 years, the value on that house has more than tripled.
Amazing.
That is amazing.
I find the closer you are to the beach on the Carolinas and Georgia, the better, the higher the pricing is appreciating. Mm-hmm. So we got a 2% rate. 2%. That's definitely a favorable rate for the borrower, right? Mm-hmm. Payment's $460, but the term is pretty short. If this was a 360 term, this thing would take forever to pay off. But it's a 119 term, which means it's a tick under 10 years, right? Basically 9 years, 11 months. So that's the term of the deal. It is a bond for title in, South Carolina. The current unpaid balance, about $26,600. So it's been paying for a while. So it had 119 months when it started, and it's got 5 years left now.
So that's something we should bring up for the crowd a little bit. You said this is in South Carolina a bond for title.
Yep.
We find deeds of trust in California and trust deeds. In Texas, we find vendors liens. What else do we find? We have contracts for deeds. We deal with those. What else,
Yep.
Justin?
Land contract, note and mortgage. There's in Michigan, I think it's Michigan, they have some sort of, or in Kentucky, I've heard it called a covenant deed.
Right.
Deed. There's
Right.
all sorts of names. Basically, all these things are pretty intermixed. So there's a deed of trust, like Richard said, which is very similar to the note and mortgage, except there's a power of sale clause built into the deed of trust. That's the main difference. And then there's basically a land contract, also known as contract for deed, also known as contract for real estate, also known as bond for title, also known as there's a few other ones, but basically they're all just land contracts, if you will.
Right. So I bring that up though, just so if somebody is investing in notes out there and they get something like that thrown at them, they'll say, okay, fine. I generally get this. You should check it out and find out what specific requirements go along with that. Like a contract for deed is very, very different than a deed of trust in terms of how it's owned, but it all gets you to ownership in some way.
Right. So we don't like land contracts, but in this case, we do like the land contract because there's a lot of positive things about this deal that make us okay with buying it, which is why we bought it. So we typically speak out both sides of our mouths because we always say we don't like land contracts. We prefer note and mortgages, deed of trusts. But sometimes these deals are great and these situations are really good, and we feel okay dealing with the fact that we have a bond for title. So there's nothing wrong with it. It's just something that we prefer not to invest in. But in this case, we are, and we have good reason.
Does that hurt to speak out of both sides of your mouth?
It does. It does. See, you can be a ventriloquist, right?
That's right.
You feel this side of your mouth, both sides at the same time.
All right.
All right. So we got 5 years left. We got 5 years of payments, 5 years left. So it's half life on this loan. Everything's looking great. And basically, we're ready. This thing's ready to offload, Richard, for $23,000. It gets somebody an 8% return, $460 payment for 5 years, 1 month.
Mm-hmm.
Sounds pretty good,
right?
Let's talk about the redeeming factors of this loan. We got this condo. It's a bond for title land contract. Yeah, it's a land contract. I know we talk about it a lot, so we'll quickly explain the land contract because some of you may be like, "Well, what's the difference?" So on a promissory note and mortgage that you sign on your primary residence, which you'll get from like a Wells Fargo or a big bank or whoever you go to get a loan to buy your house, you're going to sign a promissory note as one document that says all the terms, 6% interest rate, 30-year amortization, your payments, $700 a month, and you owe us $60,000, something like that. The mortgage says there is debt on this property, and they spell out the property in the legal description, and they say all the security for it that the bank gets if you default. They spell out all the ways that you default and how you're in default. That's what the mortgage does. The land contract is very similar, but it's all encompassed into one document. Okay. So that document spells out the terms and it also spells out the security and the one document called a land contract, in this case, a bond for title. The negative to the land contract is that you as a lender are on the deed still, even though you have a borrower getting equitable title in this contract sale. On a note and mortgage, you as the lender, you are not on the deed. You are not the deeded owner, the property owner. You are just the lien holder on it. In a land contract, you are both. You are the lien holder and the deeded owner of the property because you are vesting title once all the installment payments are collected from that borrower. Hopefully that was clear and it wasn't too muddy. So in this case, the bond for title, we are getting a deed from the seller of the property, who happens to be the note holder, who does not live there, right? Because the borrower lives there. And we are also getting a conveyance of the land contract. So we have an assignment of land contract, and we have a quitclaim deed, I believe is what we did, or maybe a special warranty deed to get the deed in our name. So now we are the condominium owner. We're proud owners of the condominium unit out here in Bluffton, South Carolina. And we are also the lien holder as well. Hopefully that explained things.
Mm-hmm. I understood.
The very beautiful thing about this, Richard, is that now you're in the investment to value ratio of 15%, meaning the value of this property we're estimating at $150,000, probably higher, so we're being conservative. And the investment in this is $23,000. So you are 15% of full value of this condo. So that means if anything goes wrong with this deal, there's a very slim chance that you won't get back that you'll get back less than a penny of what you put into it.
Right.
It's very low risk. Nothing is safe. Nothing is guaranteed. It's a very low risk. I don't think I've seen a 15% deal in a long time unless it's a non-performing loan.
I agree.
Yeah. The borrower LTV, the loan to value ratio, is 48%, Richard. So that means that the borrower bought this property for $55,000 in 2017, and then now they've paid down the debt with their down payment, and now they only owe $26,600. So that's 48% of $55,000, and that's where we come up with the loan to value. Now you can say loan to value could be the value of the house today, but that's not how we're considering it in this setting. We're saying the borrower has that much equity. All right. We don't perceive it to be $150,000 in the sense of the borrower LTV, because we're just trying to compare it to when they bought the property. Sorry, I had to take a drink. It's a condo. Who doesn't love a condo? It's a self-maintaining property, right? Somebody else is taking care of the outside and beautifying it and taking care of that. Only thing that you're worried about is the inside. So that's what we like about the condo. It's a condo. The borrower has great loan to value. The investment to value is extremely low, the lowest we've ever seen for a performing loan. It is a bond for title. So, Richard, the caveat to this that's kind of annoying, but it's something that we can deal with, is the fact that not only a condo has fees, right? Like a homeowners association. There's taxes and insurance that need to be paid. That's being escrowed. I don't know if this account's actually being escrowed or not. I believe it is. And there's also insurance, right? So with a condo, in this particular one, they have a master policy. So there's a master policy over the entire building, if you will. We'll say this building is 614, okay? And let's say the building next to it 616. So there's a master policy that the condo association has on the building, and then there's a small so you have to be on that endorsement, right, as one of the condo owners. And it's also a homeowner's policy, right? That's also for the condo that takes care of all of your stuff in there. So there's actually two policies that you have to kind of be the endorsement on there, the mortgagee. So that's a little bit different. So
Right.
we say those things because we want transparency to know that, these things are a little bit annoying, but with a 15% ITV, this is a very low risk opportunity. So that's what we got. So we bought that because we know we can just hold it for a while. It's a very low entry level loan, if you will, to get a pretty solid 8% return. If you guys have any questions about that, you guys can combining the word
So
chat
I'm
and type
just,
at the same
it's
time.
just going through my mind. Yeah, I'm just going through my mind here in terms of condo fees. So you always have to kind of think about those. We would underwrite those in our underwriting as a potential cost, yes or no?
Only if they're not being paid.
Okay.
So we know there are some condo fees out there, and we do check to make sure that they are paid. But for the most part, we're not in fear. In most states, and you know this, Richard, I'm just saying this for the audience, is that in most states, the condo fees aren't going to step in front of you. There are some super lien states that you want to be aware of for homeowners associations, but for condo liens, I'm not sure if there's many states out there. If there are, there may be a couple, but this state wasn't an issue for that.
Now, do you ever find that there's an HOA and a condo fee?
I've not seen one.
Okay.
There
So it'd
might be. I don't see how that would be.
either
It might
or.
be like double dipping, right? For the association to double dip you.
Right. So let's see what Michael has to say here. He says,
Right.
how healthy is the general fund? Any liabilities? Good questions.
So any liabilities? Well, as the lender, you're on the policy for the insurance. So if something happens to the condo, if the whole condo building burns down, you're covered by the master policy, right? And then also if the individual stuff inside um, the condo, which is really what you own, that stuff is covered by the homeowner's policy. So there's no fear there. As far as liabilities for you, that's a great question. I don't know if there is or not. I'm trying to think of a negative situation here, something scary, but I don't see how, because the public can't get to anything in the condo that you are the owner of for them to get hurt on. Like, for example, I'm thinking of if you own a rental and the sidewalk has a dip in it, right, and a difference in an elevation between one part of the cement and the other part of the cement. Somebody trips over it and they sue you because it's right in front of your house. Like there's a liability there, right? In a condo, I don't see where a liability is.
You would have it if you bought it under a contract for deed, because then you would be the owner.
That's what we did.
Right, but you'd have to be insured. You'd have to get lender's insurance on that.
So we are covered in the master policy for the main building of the condo. Then also everything inside the building, you're covered for that as well. So
right. So Michael says, sorry, he meant litigations.
Litigations.
Liabilities, litigations. They're close,
It is. It's easy. It's easy to do that. I don't see how, since I've been being the bank since 2016. I know Richard's been doing that as well, a little bit longer. I haven't seen any liabilities on my side, especially when it's a note and mortgage. There really is no liability. Being the deeded property owner, yeah, there might be some liability or some litigation, I guess, there's a chance there. I guess if something were to, I don't know, if I don't see any litigations that come back on even if you're the deeded owner, because you're also the land contractor, because you can prove that you're not the equitable borrower, if you will, if I'm saying that correctly. So I don't see any litigations being an issue.
Right. So the only thing would be something like a special assessment. And this actually happened to me when I was flipping houses. So I can give you firsthand knowledge. And that was that I did buy a condo. I was flipping the condo. They had a major storm. They had some major roof damage. Long story short, everybody got assessed $10,000 because the condo association, just did not have enough money to cover those damages, even with the insurance. And it was like a game of musical chairs. I got stuck, even though I was going to only own it for probably 120 days. I was the owner during that time, so it came out of my pocket.
So the fact that there's such a low ITV here, we can deal with some of this stuff. It's not end all, right? Because if we had to foreclose on it or take it back and resell it, there's so much juice in there that there's no fear of losing an investment per se. I mean, there's no guarantee to it, but it's very low risk. So at the end of the day, that's really why we bought it, because it's such low risk. We had a great borrower, still have a great borrower. They made their solid payments all the way through. We've been communicating with them. We're on the insurance policies. Like everything is pretty sound with this deal, and that's what we were hoping for, and that's what it came out to be.
Right. So in this case, where the person is actually living in it, et cetera, you would expect them to pay that $10,000 that I had to pay.
Yeah, exactly.
In my case, it was vacant. It was being renovated. And I was the only person there to pay the bill.
Yep. Yeah. If you ever have any fear of this stuff with the land contracts, you can always just convert them to a note and mortgage or a note and deed of trust, depending on what state you're in. So that isn't an issue. There's a cost to it, but sometimes it's worth it if you don't want to deal with any of the headaches. When you have a lot of them like us, sometimes we just kind of wait to fix it until we need to fix it, if you will, right? If it's not broke, don't fix it. And so we do that, but we kind of wait for it. Right. All right. So that was the case study and also opportunity to buy. So guys, we buy liens. All right. If you have your smartphone out again, wave it, take the camera out, wave it over the QR code. You'll get to our form. There, if you're watching the recording of us, you can pause it, take your picture, fill out our form, give us the information about the deal that you have. We're looking for land contracts, contracts for deeds, note and mortgages, note and deed of trust, lease options, you name it. If it's a lien on a residential property, a single family dwelling, 1 to 4 units, That's in our wheelhouse. That's what we like to buy first. We even buy seconds as well, but we typically buy firsts. I know it says we buy first liens up there, but we'll look at a second. We don't mind looking at it and giving you a price on it. Richard apparently is lending seconds, so yeah, I guess that's what we're in the market
if I'm
for.
lucky, I'll be able to place this loan. But it's funny. I don't get many requests for them, and one of the leading dealers in the secondary market, not the secondary market, because all of us who buy notes are the secondary market.
Yes.
The seconds market is actually totally getting out of the business because it's pretty rough out there right now for seconds.
Okay. Well, Richard, we're going to pause quickly and we're going to go into some details for the next meeting that we're going to have, which is Wednesday, November 9th, 6 to 8 p.m. Richard and I will be back from a big major note conference called Note Expo, and we'll be able to talk more about kind of what some of the industry experts are saying and what we kind of learned from the conference. That'll be a good session there, Richard. You can follow us on BrightPath Notes in Facebook, Twitter, and Instagram. You can hit me up, Justin, at brightpathnotes.com or Richard at amnotecap.com to get a hold of Richard Thornton. And so don't forget that we do have a Facebook group. It's called Be the Bank, surprise, surprise, Real Estate Note Investing. So you look for this little logo in the background that says like Be the Bank, and we have the deal flow to make cash flow. That's how you know you're in the right group. Please read all the rules and stuff in it and accept and follow the rules. Otherwise, you won't be approved into the group. But this is a great way to ask questions, and we can bring them up for future broadcasts that we have or any deals that you guys have you want to bring on the call. We can talk through them as well. And guys, hang on in there. We're going to segue into our kind of Q&A or fireside talk conversation. And then we're so hang in there, and we're going to transition to the next segue. I won't say segue into the next segment. There we go. Too many segs in one sentence.
You got too many.
But
we got to urge people we should urge people to sign up for Note Expo themselves, because you too can attend and learn a whole lot about notes.
That's right. It's open to the public,
right?
But you have to pay for it. It's not free.
If they'll let Justin and me in, anybody can go.
Yeah, we'll let anybody in.
Yeah.
All right. We'll be back in just a few seconds. All right, Richard, that was a really good broadcast today. I think we got a lot of information out there. I had a couple stumbles there through the entire broadcast, but overall, I think I gave myself about a B-.
Yeah, I'd say the same for myself. We're getting back into it. You've been gone for a while, so.
Yep. All right. So do we have anything on the board before we start getting into something?
Nothing on the board today. It's kind of quiet. Usually we have 7 or 8 people asking us questions, but Michael's the only real person who's paying attention.
Michael's our guy, man. He's not afraid to ask questions. Right. He's just putting it out there. He wants answers. He's hungry. He's motivated. It sounds like he's going to do a deal if he hasn't done some deals already. Right. So Michael, we appreciate that very much.
And not everybody is in a situation where they can ask questions. They're driving in their car. Or
That's true.
Like that.
Yep.
But
yeah. They're at their kids' choir concert, but they're really focused in on this conversation here. They're trying to advance their note investing skills. I get it. Yeah.
Right.
I say that because my oldest daughter is also in choir as well. So.
Okay. So I'd say one of the just most interesting thing that's happening right now is that we are really seeing the wind up for the pitch for non-performing notes here. And it's taking us longer than we thought. But that's actually a good thing because it gives us a little bit longer time to set up. We probably should have said this earlier, but we're setting up a fund ourselves. And if anybody would like to invest along with us in doing that, we would certainly urge them to do it. Minimum investment will probably be something like $25,000. And we'll have a fairly good pay rate on that. So we'd like you to inquire about that.
Yeah, it's perfect for the individual that likes the idea of making their security this type of investments, but also doesn't have the time to deal with the day-to-day stuff or learn all the ins and outs of it. And that's okay too. We have different or various programs for your investing desires. So,
Right. Right.
Michael, wanted to give a quick shout out, Richard, and say I
Mhm.
appreciate all the information. And Michael, we appreciate you. Thanks a lot for hanging on the call, the broadcast today, and appreciate all your questions. And feel free to reach out to us directly, man. We're here to help you.
Right. So I was going to ask you, Justin, do you, with your Cyria group, do you broadcast this broadcast? In other words, do you pitch it and let them know that we're here?
Do I pitch it to who? I'm sorry.
Your Cyria group?
Yeah, so they are actually a part of it. So this is considered the subgroup for the Cyria
Okay.
real estate note investing. So they get the advertisements to see this. So most people like to watch the recording of this. To be honest with you, not very few people actually are able to watch things live anymore. I've noticed that with a lot of other people that do live streaming. Most people just like to watch the recording because they can fast forward through some of the stuff that doesn't pertain to them or what they're interested in learning.
Mhm.
Which makes sense, because I did the same thing. I
Yeah.
ain't mad at you. I ain't mad.
Right. So do they also crank us up so we're talking at 1.5 speed? We got these little high voices that go really quickly.
Yeah, I do that too sometimes. I'm like, oh, it's a 45-minute presentation. Okay, I can get that done in about 25 minutes here.
That's right.
1.5x there. Yeah.
That's right.
Michael asked quickly, will this be a fund? Yes, Michael, it would be an actually fund. It'd be a regulated fund with proper documentation and all that stuff. That's what we're aiming towards. We're getting that set up, and we're going to be able to unleash more information. So we're happy to provide that to you, but just please reach out if that is something of interest to you. Anyone on the call, listen to the recording, and we're happy to explain what we're trying to do.
Yep. I can't think of much else that's going on today. I'm looking really forward to Note Expo.
Yep.
There's going to be a lot of vendors there that are going to have a lot of information regarding investing in notes. And there's several other groups that are setting up servicing companies. And so I think there's a lot of people sort of getting ready to go and getting their motors started. And there's a lot of money out there right now. So that's all good.
Absolutely. We are excited. We're ready to end this fourth quarter with a big bang. Richard and I have closed a lot of deals this past 6 months. We've actually accelerated quite a bit in the second quarter all the way to now. If you guys are looking for deals, do not hesitate to hit us up. And if you're looking to put some money somewhere as well. So yeah, just get a hold of us. Justin at brightpathnotes.com or Richard at amnotecap.com.
Right.
Excuse me, man. I've been coughing a lot today. All right, so this is all the time we got for today. Appreciate all the questions from Michael. Thank you very much. And we will see you back in November when we are fresh back from Note Expo. Don't forget to check out the BrightPath Notes other things, our website, BrightPath Notes. Follow us on Instagram, Twitter, and Facebook. And then please subscribe to the Be the Bank podcast as well, where you're going to hear more discussion, debate. It's less educational, more debate, discussion type of topics. You can do a drive one way to work or whatnot, 20, 25 minutes. You can knock out an episode. 26 a year, Richard. Just saying.
Sounds good to me.
All right.
All right,
guys.
See you next month.
We will see you November 8th? Yeah, November 9th.
Okay.
Wednesday, November 9th. Be there or be square.
Okay. Bye.
Bye-bye.